Well, thanks everyone. One of the core assertions of the factors for the fundamental investor program is that the old paradigm of allocators paying 2 and 20 fees for black box returns that includes beta, that includes factor P&L, is not as prevalent, and that allocators have become much more sophisticated in evaluating and decomposing return streams into ideo and factor. Now, that's kind of just been a hunch. I thought it would be fun to actually speak to an allocator and talk to an allocator how he has evolved his framework on evaluating return streams from hedge funds over time. And so I was introduced to Chad Myrhe, who is a managing director at the Alfred I. DuPont Charitable Trust and is an active allocator to hedge fund strategies. So thanks for being with us, Chad.
My pleasure. Thanks so much for the invitation.
Maybe could you start and just kind of walk us through your background and then walk us through your core day-to-day responsibilities in the seat you're at now?
Yeah, absolutely. So I've been an allocator for about 17 years now. Started my career with a consultant on the West Coast. Spent a decade working for two large public pension plans in Missouri. Ran a portable alpha program for one of them, a factor-aware equity program for the other. Then I moved to Pittsburgh, where I headed up all public markets for a large family office. And then last April, I joined the DuPont Charitable Trust here in Jacksonville, where I oversee all public markets, including commodities, fixed income, hedge funds, and long-only equities.
And could you just walk us through, at a very high level, your manager evaluation framework? What are the core buckets of considerations that you evaluate when you're thinking about making an allocation to a manager?
Yeah, so I think that's very strategy specific. So if I'm underwriting a stat arb manager, to give you an extreme example, I'm going to be very focused on the track record, specifically the near-term track record, because that's a real-time view of the signal's effectiveness within the markets. Now contrast that with a manager that holds a 10 to 15 stock portfolio and is looking at industry dynamics over a 5, 7, 10-year period. The short-term track record in that instance makes almost no difference whatsoever. It's almost completely irrelevant. So in that instance, it's going to be much more qualitatively driven. But I think regardless of the strategy that I'm underwriting, there's really a common thread. And I want to answer three main questions. The first question I want to answer is, what is the market inefficiency? The second is, why does that inefficiency exist? And why will it persist going forward? And then the third and most important question is, why is this manager that I'm underwriting uniquely qualified to exploit that inefficiency? So that's kind of the underwriting process in a nutshell.
What is the standard, process just logistically? Like generally, how are you identifying and being introduced to managers? What is the vetting process? How long does that take? And from start to finish, what is like a typical allocation process look like?
Yeah, so I would say it all starts with sourcing, and there's a lot of avenues to finding new managers. So there's obviously, where I like to start is to talk to my existing managers and say, who do you compare notes with? Who do you think highly of? I think that's a very fertile ground for finding new exciting managers. Every prime broker has a cap intro division. They're very helpful in terms of helping you map out the universe of managers. They're very up to date on who the new launches are. So I'm in contact with 3 or 4 of them on a regular basis. Another thing that I like to do is find a position that has gotten kind of crowded across the hedge fund universe, and then just look back at that position via 13Fs historically and see who got there first, who had the conviction to size it up really big within their portfolio earlier, and then just to reach out to that manager directly and say, like, how did you get there? What's the research process like? And that's been a fertile ground for finding new managers. But I think the most effective way is I've just created this network over time of people who think very similar to me, are attracted to similar managers, and just to compare notes with them to see who's in their portfolio, who they really like, what they're excited about. And I think that ensures that I'm not missing out on anything. So that's kind of the sourcing process. In terms of the vetting process, again, it's going to be strategy dependent, but it's always going to be some mix of qualitative and quantitative factors. And that mix is going to be highly driven by the underlying strategy and the sample set that I'm dealing with, right? So if you have a manager that's turning their portfolio over once every month, right, you're getting a sample size that is statistically significant. So I'm going to spend a lot of time thinking about, the quantitative research there, because that's going to be highly reliable data. Now, if you have a manager that trades one or two stocks per year, I'll still run the quantitative research, but that's really going to be taken with a grain of salt. And that's going to be much more about just like getting to questions to ask the manager. And then I'm also overlaying a lot of qualitative aspects in terms of the manager's process, their pedigree, the quality of the team that they have on staff, motivation, those types of things. But again, it all gets back to what's the inefficiency within the market and how is that manager exploiting that inefficiency?
What's your typical batting average on new manager goes into the vetting process versus allocation? Are you turning over 10 stones for every new allocation, 100 stones for every new allocation? Like, what's your hit rate historically?
It's definitely in the single digits. I mean, the reality of this business is there's a lot of costs associated with turning over your manager portfolio. And those are obviously dollar costs in terms of the slippage and the transaction costs, but it's also just a huge burden on your team, the legal team, the operational due diligence team. So not only does this new manager have to be better than the old manager, but they have to be better than that old manager, and they have to be so much better that they're overcoming the costs associated with making that swap, right? So the bar is incredibly high. And as a result, you have to turn over a ton of stones until you find something that's truly unique and truly powerful. And then you can switch out one manager for another.
So single digit percent of your portfolio you're turning over per year, or single digit number of managers?
Yeah, single digit percentage of the portfolio. So when we enter into a relationship with a manager, we're kind of looking out 10 years, right? So if that would imply kind of a 10% turnover in the portfolio. And then we're just looking at a lot of managers.
Like in a given year, ballpark, how many new managers would you vet to make how many allocations? Are you looking at 100 new managers per year to make 3 allocations, or what's the sort of, ingestion versus allocation mix?
Yeah, that's really going to be dependent upon the asset allocation. I mean, usually the most activity is a result of a change in the allocation. So let's say you decide to you decide to increase your allocation to hedge funds. Well, now you have to go either size up your existing managers, or you have to find 3 new hedge funds to reach that target, right? So that will be kind of this one-off where you're really looking to put money to work. And then it's more about just mapping out the existing environment set. And maybe you look at 50 managers and you find 2 or 3 that you like and you add them to kind of fill out that underweight. If it's more steady state and that there's been no changes at the asset allocation level, that's where the bar gets incredibly high, because you already have a fully built out portfolio. And now you have to go out and you have to find a manager that's just so good that they're unseating one of your existing managers. And that's where the hit rate becomes really low.
You've had a front row seat over the last 17 years to some pretty interesting trends in the hedge fund industry. You've had the rise of indexation, private equity and venture capital have eaten up larger shares of allocator portfolio. And then you've had the shift towards multi-manager hedge funds really accelerated over the last 5 to 10 years. What do you make of those trends as you kind of sit from your perspective?
Yeah, so the hedge fund industry has always been evolving, right? So I go back to when I first started in this business, and it was all about the fund of funds and the traditional multi-strats, right? Like the distressed debt, merger arb, you have a little bit of credit, you have a little bit of long short equity. And I think the evolution has moved towards delivering value that you can't get elsewhere in the portfolio. So from that standpoint, I think it's been a positive, right? And people tend to focus on just the headline fees, but when you think about the true alpha that you're getting for those fees, I think the course of travel has been in the right direction, right? So I go back to kind of the early 2010s, the proliferation of kind of the Tiger Cubs, and they generated some really great returns. But I think a lot of that was just kind of being in the right place at the right time, right? Buying the quality compounders, being in tech. They were early in China. I'll give them complete credit for that. That was a good call. But I think the multi-managers have been really good at saying, okay, what can we deliver that allocators can't get cheaply elsewhere, right? They can get equity beta, they can get factor beta, they can get geographical tilts, they can get that really cheaply, and they probably should within their portfolio, but they don't have to pay a hedge fund fee to get that. What the multi-managers are delivering is that pure idiosyncratic alpha that is very rare, and it's by definition uncorrelated to anything outside your anything within your portfolio, right? So I think whatever you're paying for that, as long as it's a good alpha split between the manager and the LP, you should be willing to pay that.
So, Chad, how do you think about what is in the realm of manager skill versus what lies within the allocator to ultimately make the decision, whether that's style factors or sector tilts? What are you willing to pay alpha fees for, and what are you not willing to?
Yeah, so I think that that's kind of a contentious issue among my peers. We debate this all the time. My personal beliefs around this are twofold. One, there are a few factors that get rewarded over time for either behavioral reasons or it's just an additional risk premia. So you're taking on additional risk and get rewarded for that. But that's largely commoditized. And I don't believe that that can be timed, right? Like the quants will tell me that there's some time series momentum associated with factors. So if a factor is working, it should tend on average to continue to work. But in terms of, I think that it's a good time to buy value, or I think it's a good time to buy quality, I haven't seen any research. I haven't seen a whole lot of anecdotal evidence that proves that that can be timed. So I'm not willing to pay for that exposure. I think it should be in your portfolio, but you shouldn't be paying hedge fund fees for it. Now, when you talk about geographical tilts or industry tilts, I think it's less black and white, right? Like if you believe that, the insurers are in a good position relative to the hospitals, like I think there's something there in terms of timing. And if you run a regression, that's just going to show up as factor exposure. But I think you do have to give the manager a little bit of credit for their timing in terms of that. I think what kind of gets under my skin is if you have a manager that is a US tech focused manager, that's all they've done, that's their preferred habitat, they don't change. I will never give them credit for the tailwind that they've had because their preferred habitat has been in favor. So what I'm really focused on is that true idiosyncratic alpha, something that can't be explained via factors, can't be explained via factor timing. And then there's just a little bit of gray area where you have to give the manager the benefit of the doubt in terms of their alpha generation outside of that.
Are there any specific factors that, based on your experience, you would recommend investors either overweight or underweight on a structural basis?
Yeah, I think the approach that we've taken is you just go out and you find a bunch of great managers and you put them in a portfolio, and then you see the sector tilts that kind of boil up to the top, or the style factors that boil up to the top. And in terms of sector tilts, the academic research shows that every sector basically generates the same return over time, right? It's not as easy as I'm just going to be overweight tech and expect to get an excess return over the market, because the market knows that tech stocks are really good and they bid it up to the go forward rate of return being equivalent to the other sectors. So I want to remain sector neutral at a total portfolio level. At a geographic level, I want to remain plus or minus equal for similar reasons. I think there's no reason to believe that the US should outperform Europe or EM over time. Now, valuations come into to play there, so you may want to take a tactical view, but on a steady state basis, you want to remain neutral. In terms of style factors, like I said, I do believe that there's kind of 3 or 5 style factors that generate excess returns over time. There's not 300, but I think there is a lot of academic research that shows that value, momentum, quality, low vol, defensive, however you want to define that. These are some factors that I do believe should generate excess returns over the market index over time. So if my portfolio is leaning in that direction, I'm not going to actively hedge out that risk, right? Like I don't want to spend a lot of active dollars leaning towards those factors because I think it's a very low Sharpe ratio strategy. But if they boil up to the top where I have a value tilt, I'm going to keep that on in my portfolio because I think it does get rewarded over time.
What happens in your career when you've been short momentum or short value, short quality, which probably doesn't happen often, but what's that hedging process look like? Are you working with a broker to access a hedge basket, or what's kind of logistically is the process to get that factor orientation back in line with where you'd want it to be?
Yeah, so I think that it starts with just manager sizing. That's usually the path of least resistance, right? If you put all of your portfolio holdings together and it shows that you're underweight value, then you can go to your value manager, give them a little bit more money, neutralize that. That's not a big cost associated with that. I think the step 2 is what you said. You reach out to a broker, you get a factor basket, you backfill, or else you just look at the individual positions, right? Like there's a lot of the market being driven by NVIDIA. So if you're underweight NVIDIA, it may just be as simple as going out and purchasing some NVIDIA stock, and then that's going to give you exposure to the idiosyncratic return of that stock. It's going to give you some semiconductor exposure. It's going to give you some growth exposure. It's going to give you a lot of factors. And if those are a net positive to your portfolio, that's a pretty low cost way to get that exposure and hedge out those unintended bets.
You mentioned that you don't want to give managers credit for just living in their preferred habitat. And take a tech manager who launched in, spring of '09. That manager has had an incredible tailwind and probably thinks he or she's pretty smart, having compounded at a very high rate for 15 years. How did those conversations go? And can you just dig a little bit deeper in terms of how you evaluate that track record and isolate what is a tailwind from the habitat versus true idiosyncratic alpha generation?
Yeah, it's such a good question, and I think those conversations. I've been having those conversations with my managers for years. I think it's pretty hard to acknowledge that your track record was largely based on the luck of being in the right neighborhood at the right time, and less about just your skill as an underlying manager. But I think it's gotten a lot easier since 2022, right? Because there's kind of a reversal of the things that worked. So it's been interesting just in terms of talking with my managers and also talking to my peers. So pre-2022, I brought up a lot of these tailwinds to managers, and I would get a lot of pushback of I don't know what you're talking about. This is a really talented manager that generated incredible returns. And then 2022 happened, and you had an unwind of China, you had an unwind of biotech, you had an unwind of tech. And then it was really easier to sit down with your managers and say, hey guys, you actually generated alpha this year. You just had a huge headwind. That's the good news. The bad news is you've had a huge tailwind for the last decade before that. And then I think it kind of opens their eyes to, yeah, we need to think about this a little bit more holistically. And the fact that the LP community has kind of come around to this way of thinking. Now, not only are they hearing it from me, but they're hearing it from a dozen other LPs, and I think they're kind of adopting their strategy, or at least the way that they communicate with their investors in a way that's much different from prior to 2022.
Yeah, so 2022 was a year where the tide went out. It was much easier to evaluate strategies based on that was almost a stress test for certain manager strategies is by your thinking.
Yeah, absolutely. Absolutely. And I definitely think that it blindsided a lot of managers and just made them aware of how bad the relative performance could be. And the nice thing is when they kind of dig in and do their homework, they realize that a lot of the P&L is being driven by these unintended bets. And they were unintended bets that worked in their favor for a long period of time. But I think they've just gotten a lot more intelligent about understanding the bets that they're taking and building a portfolio where the unintended bets aren't completely overwhelming the intended bets and kind of covering up the true skill that manager has.
Right, right, right.
And to get back to your question of how I'm adjudicating that, so I think it starts with the more transparency I can get from a manager, the better, right? So Bloomberg has a great tool where you can upload all of the historical holdings, and they'll run it through their factor models. And basically what I'm trying to do is just separate skill from luck, right? So you start with the track record, you back out all of these things that are, it's either their preferred habitat or they didn't make a conscious effort to move into a geography or a sector or what have you. And then what you're left with is just that idiosyncratic security selection alpha that can't be explained from the factor model. And that's what that's what I consider true skill. That's what I think is very rare. That's what I'm willing to pay a bunch for. And then it's really upon me to kind of build a portfolio around that skill so that what I'm left with is kind of this lower volatility portfolio that's just being driven by individual security selection.
Could you just maybe walk us through like where we've been versus where we're at now in terms of allocate, like conversations with your allocator peers? It seems like at least maybe 10, 15 years ago, there might have been a frustration of lack of transparency. How has that shifted over time? Is this framework of evaluating, decomposing return streams to factor and IDEO, is that more standard now, or where are we at in this evolution towards P&L dissection?
Yeah, it's really interesting, and I was lucky enough to kind of cut my teeth at a shop that was early to really understand factors and understand true alpha and differentiate the two. And the conversations that I had with my managers were difficult because they kind of didn't want to give you their holdings. They saw that as trade secret. Um, and I think that changed a little bit post GFC when people realized that they needed to know what was in their portfolio so that they could really underwrite the risks that they were taking. But it still wasn't best practices. And I think we're slowly moving to a place where we're getting to the point where, best practice is full position level transparency with the leg on both the long and the short side. And we got a long ways to go, but I think we're getting a lot closer to that. And I would say in terms of just my peers, it went from, I don't know what you're talking about, to, yes, let's engage. This is how I think. How are you thinking about this? Let's kind of tag team and go back to the manager and have similar conversations. So they're hearing the same thing over and over, and they know what we want. And hopefully they'll be a little bit more accommodating with the data packs.
And so are most managers, single managers now giving full trade sheets with a leg? Is that like, how standard is that from a data pack perspective?
Yeah, I think there tends to be a lot of sensitivity on the short side, which is understandable. So I think I think we're ways off from that being market standard. But in terms of long positions with the leg, I think that's becoming the standard.
What is your advice for articulation from managers in this realm of factors? Like, are there certain things managers do in quarterly letters, decomposing their return stream? Like, what are your expectations for managers to actually understand the decomposition of their return streams?
Yeah, I think that's been the biggest evolution. Just reading quarterly letters over the last decade, the the only conversation around factors was when a factor moved against a manager, and then they blamed that for their poor performance, right? There's no acknowledgement of the tailwind that had occurred in the prior 5 years that led to some really good performance. I think we're now at a point where the good single managers even not only write about factors and how they're thinking about factors and how it's affecting their portfolio, but they'll give a decomposition of this, 90% of our alpha last quarter was IDEO, 5% was market beta, 5% was quality, so on and so forth. And that's incredibly helpful from an allocator seat to just form proper expectations of that manager to know that they're delivering true value that we should be willing to pay for. And then it also gives you a better understanding of the little factor tilts that they're taking, because that doesn't mean much at an individual manager. But when you put 10 or 15 of these managers together, it can percolate up to something that's meaningful for us. And then we need to go back to the drawing board and think about the best way to hedge out those factor risks.
And Chad, how does all of this tie into the evolution of fee structures? My general sense is there's been fee pressure across the board, yet certain of the multi-manager, multi-strategy firms have been able to actually raise fees over the last 5 to 10 years. Can you just walk us through how this factor decomposition trend impacts the fee pressure that allocators are exerting upon managers?
Yeah, so I think it's kind of, I mean, you go back historically and there was just kind of the standard 2 and 20 or the standard 1.5 and 20 fee structure. And then that kind of evolved to, hey, you guys are running 40% net long. You should be starting with 40% of the S&P 500 as your hurdle. We're not paying you for that beta. And I think that's gotten a little bit of traction. And now we've just kind of taken that to the next level of, hey, we shouldn't be paying you for 40% of the return of the S&P 500. We also shouldn't be paying you for the structural long to a factor that gets rewarded over time. And I think, yes, the multi-strats have been able to pass along some really high fees, but I think it's defendable because that's true alpha, right? If they're doing what they're saying they're doing and they're hedging out all of the systematic factors, then what you're left with is just the idiosyncratic alpha that is diversifying. It's rare. And then the question becomes, okay, what is a fair split between the manager and the provider of capital? Is that 50-50? Is that 70-30? Is that 30-70? And that's where the conversations, I think, have evolved to. And I think that that's a very healthy space to be in.
A trend I've heard from a number of sources is the barbelling of hedge fund portfolios, where more allocators will seek their long exposure from maybe a traditional long short manager to access that long alpha, maybe hedging that on their own, or accessing that pure alpha via a multi-strategy firm. Whereas, like, historically, you might have got all of that exposure from a typical single manager long short. Is that a trend that you've witnessed as well too? And maybe just walk us a little bit through that barbelling evolution.
Yeah, so the barbelling concept is one that is somewhat new to me. What I would say is I think LPs have gotten much more sophisticated in utilizing derivatives to build the exposures that they want and not have to pay a lot of money for it, right? So I can go out and I can find a traditional long short equity manager running 50% net long, or I can go and find an equity market neutral manager, get a swap for 50% of the S&P 500, and I kind of end up in the same spot. And then it's just all about, like, what are the fees that I'm paying between those two options. I've also seen a lot of LPs have a lot of faith and find really good long short equity managers and then just gross up their beta to beta 1. So if it's a net 40% long short equity manager, then just go get a swap and get some beta for 60% of the notional of the index. And now you're kind of running one beta relative to the index plus the manager's alpha. And I think that that makes a ton of sense. So it's kind of like, I think portable alpha is kind of a catch-all for a number of different ways to structure your portfolio to achieve an objective at the cheapest possible way, and pay for what you can get. I mean, pay beta fees for beta exposure and pay alpha fees for alpha exposure.
That makes a lot of sense, and something we've heard many times. It makes a lot of sense to me. What would be, if you were counseling a single manager on raising capital and reporting to allocators and thinking, thoughtfully about some of these quantitative elements of their fundamental strategy, what's the advice that you would give that manager?
Yeah, so I think the number one piece of advice that I would give them is don't dismiss factors, right? Be very upfront in terms of, this is the factor risk that we're going to run, and sometimes it's going to be a headwind, and sometimes it's going to be a tailwind. Don't fall into the trap of just kind of ignoring it when it's a tailwind and addressing it when it's a headwind, because I think LPs are smart enough to realize what's going on. So just have an open conversation about it. And then focus on the alpha that you've been able to deliver above and beyond that factor exposure, right? So if you're a manager that really focuses on quality compounders, there's absolutely nothing wrong with that. There's absolutely nothing wrong with you running a 40% net long exposure that follows that strategy. But don't benchmark yourself over a cash rate, right? Just say, hey, listen, if you would have invested 40% exposed to a quality basket, you'd have gotten X, and you got 1.2X invested from us. And we charged you this amount, and you're coming out, well ahead of the passive option. That's kind of the approach that you have to take, just an open, honest dialogue.
Is it common for allocators to hedge that exposure? So if I had a long-only quality manager, will any allocators then short the quality factor against that to access that pure alpha, or generally they're fine with that long exposure in the broader context of their portfolio?
Yeah, so I haven't seen that happen too often. I mean, there's a handful of really sophisticated investors that'll do something like that. They'll kind of create a market neutral strategy utilizing a talented manager. So not only would they hedge out the quality beta, but they would hedge out the equity beta to bring it down to a market neutral allocation. And then they can just hold that as a market neutral allocation, or they can port it on top of an equity index. I think the approach that most LPs take, and the one that I personally take, is within the hedge fund construct, it's okay to have a little bit of that factor beta, but I just don't want it to overwhelm the idiosyncratic security selection of my managers. So it's more of, okay, I have two managers that are tilting long towards quality. If I find a third, they either don't get into the portfolio, or I need to size down the two existing. So it's just making sure that the success or failure of your hedge fund portfolio is driven by the security selection that you underwrite, and not a unintended bet that just arises to the top of the portfolio once you put together the roster of managers.
How are allocators thinking about their own vol targeting approach? So say I have 5 managers who have great idiosyncratic returns, but it might only be single-digit returns and really low vol as a portfolio. Will allocators then lever up their own portfolio to optimize, to increase the vol in that portfolio? I've just heard this concept of vol targeting at the allocator level, and I wanted to kind of get your thoughts on that.
Yeah, so I think there's a number of ways you can address that issue. I mean, it's never bad to have a portfolio that generates a really good Sharpe ratio. And I think that the knock I hear all the time is you can't eat Sharpe ratio. Well, you actually can if you lever it up. right? So if you have, I mean, this goes back to when I was running a portable alpha program, it was a really high Sharpe ratio, but really low volatility, because when you combine a bunch of orthogonal return streams, it just kills your volatility, which is a good thing. And then you can just port that on top of any equity index. And now you get like really good alpha generation with low tracking error to the index. You should be satisfied with that. Um, on the other end, if you're just running a hedge fund portfolio and you just want this orthogonal return stream to diversify the equity beta or the credit beta that lives within your portfolio, you can go out and get financing to lever that up. It tends to be pretty expensive. So the approach that I've taken is, to the extent that a manager's strategy scales up, I'll try to either invest in the highest volatility share class I can find, or I'll try to talk them into running, just taking their positions and then running 1.5, times exposure for every position within their portfolio to get them to run at a high volatility level, right? Because they probably don't want to run really high volatility at an individual manager basis because they have 90% of their liquid net worth invested in their fund. But for me, I can diversify away that volatility quite easily. So it's about finding kind of the highest volatility expression of each manager's fund.
Can you tell us a little bit about portable alpha? I think I kind of like a little bit understand that concept, but I'd love to hear a little bit more about, that framework.
Yeah, so at its core is you're just separating alpha and beta. So one of the things you can do is you go get a swap on the S&P 500, right? And you pledge collateral. Maybe it's your treasuries over here. You pledge collateral so that it's incredibly capital efficient. So instead of taking $1 and investing in the S&P 500, you now have $1 where you can go out and you can invest in a hedge fund that's running market neutral. And now you take that market neutral strategy and you port it on top of the S&P 500. So your total return is the S&P 500 plus the return of the manager. And if they're running market neutral, that's just going to be alpha, right? So that's a simple example of doing it with one manager. The best implementation is you go out, you build a portfolio of 15 to 20 managers that are all uncorrelated with one another. It brings down your volatility significantly. And then you just take that bucket, that alpha engine, and you port it on top of the S&P or EFI. I've seen people port it on top of treasury bills, whatever beta you want. So you're just separating out the beta and the alpha. Whereas if you go out and you hire a long only equity manager, you're getting some alpha, but you're getting a lot of beta, and it's kind of intertwined with one another, and it's not as clean.
All right. So this allows you to intentionally select your beta source and your alpha source, combine them together to get the tailwind of the beta return.
You said it a hell of a lot better than I did. Yes.
Awesome. Thank you. Thanks so much. One of the issues we talked about is just 2022, how many managers were not prepared when the NASDAQ sold off 34% peak to trough. Now the NASDAQ has essentially doubled from the Jan 2023 bottom. Maybe some managers might have forgotten those lessons of 22. What would be your advice for managers, heading into 25, 26, 27, where who knows where the market goes? We're making no forecast, but at elevated levels of valuation, that raises the risk of another kind of 22 sort of event at some point. How would you counsel managers to think about their portfolios and potentially stress test their exposures ahead of any sort of market kerfuffle that may come in the next few years?
Yeah, so two pieces of advice there. So the first is, I think most stress tests are around just the market, the S&P 500, NASDAQ, would have you, goes down 40. We run 40% net long, so we should be down 8% in that type of an environment. That's their stress test, right? I think you need to take it a step further and say, okay, well, what happens if the NASDAQ goes down and quality stocks also sell off, or growth stocks or momentum rolls over? So I think it's not just looking at the largest drawdowns of an index. It's looking at the largest drawdowns of the factors that you are positively loading to. And I think you also need to just acknowledge the fact that when you're looking historically to see what's the largest drawdown of the momentum factor, it probably happened during a period of time where you didn't have as many eyeballs on that factor. So if we get a repeat, that the speed of that drawdown, the violence of that drawdown will probably be greater. And it may even be a larger drawdown than it was before. So I think you need to just humble yourself and take on that risk with eyes wide open. The other piece of advice I would give to long short equity managers is watch your tilts. Watch the tilts that you have on both sides of the portfolio and make sure that they're offsetting one another, right? So if you want to run long quality, long momentum, long tech on the long side of the portfolio, and you want to stress test that, and you want to tell your investors that this is what they're signing up for, I'm perfectly fine with that. But it's a really scary game to then turn around and on the short side of the portfolio, go long value, have a loading to value, have a loading to consumer staples, have a loading to utilities, like long tech, short utilities, long growth, short value. Like you're going to get stung on both sides of your book, and that's going to be potentially devastating.
Yeah, we saw a few of those happen in 22.
Absolutely. Yeah, absolutely.
Those
Absolutely.
exposures. What has been most helpful for you to get literate in this area of factors over your career? Obviously, the experience day to day in the seat. What has been helpful to you to either read or, who do you pay attention to as kind of thought leaders in this space?
Yeah, I think, not to blow smoke, but you've done a great job on your Twitter to talk about factors. Just talking to managers that have kind of come out of the Citadel, Millenniums, that kind of structure, that's been incredibly informing. I think, AQR, some of the quant funds have done a really good job of transparently describing what factors are, how they react in different environments. So it's just kind of assimilating a lot of information from a number of different sources.
Well, thank you so much for sharing all of this. This is super helpful for you and the analysts and PMs that will be a part of this program to get the inside scoop on the other side of the table. If you can't raise capital and keep your allocator happy, you don't have much of a business as a hedge fund. So ultimately, funds are in the service business to the demands of allocators. So it's I think an important part of this whole trend to monitor is the evaluation frameworks and sophistication evolution of LPs and allocators. So thank you so much for giving us a little peek inside those trends, Chad.
Absolutely. My pleasure, Brett.
All right. Thank you.